Hi, welcome back. We'll be looking at part 3 of chapter 11. We'll be working on cash dividends, stock dividends, and there's a lot of journal entries for this, so please pull out your course packs and write them down. They're a great help for homework and for your exam. We'll also look at retained earnings, and we'll also look at the changes in the stockholders' equity as we have prior period adjustments. We defined preferred stock briefly in the last section. Preferred shareholders receive their dividends before common stockholders. Again, think of those preferred shareholders as the first class airline travelers. They get their drinks first, they get their snacks first. If they have food, they get a real knife and fork, and they get off the plane first. Common shareholders follow the preferred. Preferred dividends are calculated as a percent of par value, and you need to learn a new term, which is cumulative dividend. All dividends are issued at the discretion of the company. There is no legal obligation to declare a dividend. There is no legal obligation to declare a dividend. But in the case of cumulative preferred stock, its dividends must be paid first. If they can't pay the complete dividend as a percent of their par value, future dividends must be paid in arrears before any common stockholders receive any dividends, and we'll walk through this example. Preferred stock can also be non-cumulative, and of course from the company's viewpoint this is much more attractive. So let's take a description of preferred stock. 10% $100 par value preferred stock. And we're going to see higher par values on preferred stock because the dividends are calculated as a percentage. So in this case, for this particular stock, the dividend is $10 per share. It's a firm amount, unlike common stock, which it fluctuates at the whim of the board of directors. There are different types of dividends. The ones we'll deal with in this chapter are cash dividends and stock dividends. And dividends are expressed as a percent on par or as a dollar amount per share. So you might hear, Microsoft announced a dividend of 3 cents per share. So for every share of Microsoft you own, you get 3 cents dividend. So hopefully you own a lot of Microsoft stock. There are 3 important dates related to dividends: the declaration date, the record date, and the payment date. 2 of those dates involve journal entries, 1 does not. The declaration date is the date the board of directors announce a dividend. At the point of announcement, the company now assumes a liability and is now legally obligated to pay the dividend. Record date is just a date in which they determine who is holding the stock as of that date. So any trading that occurs between the declaration date or the record date, the person who ultimately holds the stock on the record date receives the dividend. And the payment date is the date the liability is cleared. In order to pay a dividend, a company must have a positive retained earnings, not a deficit. They must have cash and, of course, permission of the board of directors. So let's take an example, and again, I strongly encourage you to write this down. On December 15th, Paquette Inc. declares a 30-cent per share cash dividend on 100,000 shares of $1 par value common stock. Paquette does not have any outstanding preferred stock, and I'm only showing 100,000 shares to make the math easier. Paquette has many more shares outstanding than 100,000. And we've got all 3 dates here. So declaration date, Paquette incurs this liability. And there it is, dividends payable is a liability. Cash dividends is a stockholder's equity account, and it's a debit, $30,000. December 29th, there is no entry, and January 20th, the dividend is cleared. Dividends payable and cash. And cash dividends will be closed at the end of the period. Remember, that's a temporary account to retained earnings. Cumulative preferred stock gets their dividend first before anybody else. So let's work an example. Rosales Inc. has 1,000 shares, 9%, $100 par value cumulative preferred stock. There's that word cumulative, and we're going to show how that plays out. If the company was able to pay dividends, in any year to the preferred shareholders, they would owe how much? $9,000. How did I calculate that? 1,000 shares, $100 par value, 9%. Okay. But look, they only declared $6,000. So they only pay $6,000. $3,000 goes into arrears. It goes into arrears because it's cumulative preferred stock and it must be paid in future years if the company pays any dividends in future years. So to declare this dividend, cash dividends and dividends payable. Now you could add, be more specific and say cash dividends, comma, preferred, dividends payable, comma, preferred. I tend to keep things more general, but if you want to be more specific in your test questions, that's perfectly acceptable. All right, so here we go. Let's fill this out. So here we have 2011. We declared 6,000 and we were able to pay it. In 2012, the company declared 60,000. So they're going to pay the 3,000 that was in arrears to the preferred shareholders, and they're also going to pay the current year 9,000. This leaves 48,000 for the common shareholders. And I think I said Packard, but it was Rosales. Okay, let's go on to stock dividends. Stock dividends are a prorated distribution of the company's own stock. So the company essentially issues more stock, increases the number of shares outstanding. If you are a stockholder, and you own 25% of the company, and at this time there's a total of 480 shares 160 shares outstanding, and you own 40 of them. You own 25% of the company. After the stock dividend is declared, if the company issues additional shares, a total of 480, you would maintain your position of 25%, and you would now own 120 shares. So you don't lose in a stock dividend. The stockholder does not lose. But it's a way to transfer money from retained earnings into paid-in capital. Now, why would anybody issue stock dividends if nothing changes for the stockholder? Stock dividends give the stockholder more stock. They increase the marketability of the company's own stock, and we'll talk about that in a minute. And they're making a statement of reinvesting retained earnings permanently in the business. So let's walk through those transactions, and then they do involve journal entries. If a company issues a small stock dividends impact have a market impact, and so if they're really big, they're going to affect the market price. If they're small, they don't have a huge impact on the market. Therefore, small stock dividends are recorded at fair market value, but large stock dividends are recorded at par value because we don't know what the market will do. And that small versus large is defined somewhere between 20 and 25%. So you're going to find homework and test questions are below 20%, and that way you'll know it's a small stock dividend. Okay, Voth Company has 60,000 shares issued and outstanding. Par value is $10 per share and market value is $15 per share. Let's say the company declares a 10% stock dividend. This involves a journal entry. So we calculate 10% of 60,000 would be 6,000 shares times the market price of $15. That would be a $90,000 stock dividends. And we debit the stock dividends account. And now look at this entry. We're moving money from retained earnings into paid-in capital. But since market doesn't equal par, we move it in proportionally. The 60,000 is moved in at par, 6,000 shares of stock dividend times $10 par, and paid-in capital takes the difference. But there's a timing delay, and so we use this account common stock dividends distributable because we have that declaration date and we have that payment date. And then we clear it out when the stock is actually issued. So let's look at the before picture and the after picture with stock dividends. I'm sorry, let's look at the after picture with stock dividends. We have common stock of 600,000. The common stock dividends distributable is 60,000. The paid-in capital 30,000, and retained earnings is 200,000. So here's the before picture, here's the after picture. Total stockholders' equity is the same. You'll note the outstanding shares are now 66,000. And you'll note the balances in total paid-in capital and retained earnings has changed. Okay, stock splits are my all-time favorite. These reduce the market value of the shares. There's no journal entry, which everybody loves, and it has an effect on par value and number of shares. So let's take that company again. Voth Company, before picture, 600,000 in common stock, retained earnings 290,000. Assume that Voth Corporation splits its 60,000 shares of common stock on a 2-for-1 basis. Now you don't have to do a journal entry, but when you report on the balance sheet, you do have to change a couple of items. This number, the total value in common stock, will not change. Number of shares and par value will change. Because it's a 2-for-1 split, this 60,000 now becomes 120,000. So in order for 120,000 to equal $600,000 in value, this is reduced by half because of the 2-for-1 to $5 a share. So none of these numbers change except outstanding shares and this description and this par value. And again, I made this simple with no paid-in capital in excess of par value. So what is the value in the stock split? When a company splits, the market responds. So let's say that Voth Company was trading at $80 a share. After the split, the market will immediately adjust to match the split, and it'll move to $40 a share. This will not affect the individual stockholder, who now owns 2 shares of stock with a total value of $80. Now, it's a crazy thing. Mathematically, it shouldn't make any difference, but lowering the price of the stock often stimulates more trades because it's a lower price point. It's as if the stock were put on sale. More trades mean more demand, which will drive the stock price up. Stock splits can be structured in different ways. Some companies will issue 3 shares for every 2 shares of stock. So you might have 10,000 at $6 par value, and if you do a 3-for-2 stock split, afterwards it would be 15,000 shares at $4 par value. The important thing is the 10 times the 6 is 60,000, and then after the split you want to make sure it adds up to the balance in the common stock account.